Federal Chair Jerome Powell just came out with a speech today. They hiked their rate by 50 basis points. So what does that mean for you? What does that mean for the economy? And what does that mean for the overall housing market? Now, basically, what I heard, if you guys have watched the speech, please leave your comments down in the description to let me know what you heard. But what I heard was that basically the employment rate is too strong. Employment is too strong, that there's too many job openings, and that the Federal Reserve is going to keep hiking rates until they see an improvement in those jobs numbers. That basically there's around 4 million job vacancies, and there's not 4 million workers to fill those jobs. And until that job number comes back into balance, the Federal Reserve is going to continue to hike rates. Because there's enough jobs out there for the people that want them. There's these companies have enough money to hire new people, and because the jobs market is so tight right now, companies are afraid to fire people because they don't have the employees to replace them, and it's tough to get new workers. They won't be able to hire that same employee back because that employee will go to another company that is hiring. And essentially, that is an example of where there is too much money in the system, because these companies have excess money, have enough money coming in to hire workers that aren't there. So the main thing that Jerome Powell focused on in his speech today, in his question, in the Q&A portion of it, he basically said that he's not worried about housing, that he's not worried about the shelter inflation for reasons that we've talked about on this channel, where basically the signing of new leases is something that's eventually going to catch up to the overall rental market, and inflation is going to cool at that time, which I don't know. I mean, in my opinion, as I mentioned in the last video, that I think these higher rates are actually going to cause more inflation among renters, because builders can't bring new supply to the market, and would-be buyers are forced to rent while they can't afford these higher rent payment, or these higher mortgage payments, and home prices are staying elevated while inventory stays low. So it's going to be interesting to see if that becomes an issue here into the future, especially if the Federal Reserve is able to get these employment numbers on track to where they want them to be. Less vacancies, a higher unemployment rate, which is something that the Federal Reserve is expecting and projecting with these interest rate hikes. So it's going to be interesting to see what happens here in the future. And as far as mortgage rates go, and where those are going, we haven't seen a huge uptick yet. When I was on the New England Federal Credit Union website looking at mortgage rates of today, they hadn't updated them yet from this morning, but as of this morning, you get a 30-year fixed rate loan for around 6%. The Federal Reserve upped their target Fed funds rate to 5.1%, as opposed to, I think it was around 4.8, 4.9, somewhere in there. So it's still right around where they were intending to go. So I don't know if it's going to have a huge effect on the mortgage market. I mean, we'll see. There's not that many mortgages being written. As far as the demand goes on the secondary market there, these investors, these people investing in mortgages, it's tough to get a return of 6% or better anywhere else. So at least right now, we'll see. We'll see what happens with mortgage rates tomorrow and going into the future here. I don't think we're going to see it skyrocket all the way up to around 7%, especially with these inflation numbers coming in good. Jerome Powell basically seemed to shrug off the CPI numbers that we talked about in yesterday's video, essentially saying that its inflation is way above they're shooting for a 2% core inflation number over time. And right now, core inflation is at 6%. So year over year. So they still have a long way to go to bring that back down to 2%. As far as what they mean as 2% over time, I think, in my opinion, they didn't specifically state this, but in my opinion, I think they're okay with inflation being below 2%. Maybe even 1% or around 0%. They certainly don't want zero inflation, but because inflation has been so hot over the past few years, or really in 2022 here, there's some room to go with that 2% inflation over time, because they don't necessarily define what that what overtime means, what that number is that they're using as an average, what that time frame is. So they're way more concerned about inflation remaining hot and remaining above 2% in the long run, or in the short run on a year over year basis. That they they seem to think, at least reading between the lines here. Jerome Powell didn't specifically state this, but in my opinion, the Federal Reserve is okay with having an inflation rate under 2% for at least some time, and overshooting that 2% target in the short term, to the downside with a more restrictive rate, because they feel as soon as they start decreasing the rate, that's something that's going to be effective into to making the inflation number go up slightly. So it's going to be interesting to see if they can actually get it to that 5.1%. A lot of people are talking about them not being able to, and I know the bond markets. I'm not a huge expert on the bond markets, but from what I've heard, the inversion of the bond markets shows that a pivot is likely coming sooner than what the Fed predicts. They Jerome Powell was very firm that he doesn't predict any rate decreases in 2023, or at least that's not something that's even on the table right now. Not something they're talking about. I think he's really trying to pound this out of the markets. But you know, I I think the Federal Reserve is determined, like he said in the speech, is their main focus are these job numbers, and until they see unemployment going up, until they see the job vacancies decreasing, and we get back to a more balanced job market, or at least see numbers trending in that direction, that they're going to keep increasing rates, and I think they're going to do it at a slower pace. Maybe they'll do another 50 basis points hike in February and then go with 25 basis point hikes, or maybe they'll just stick with 25 basis point hikes from here on out. But I think they're going to maintain this elevated rate and keep increasing the rate until they really see a big shift um, in the jobs market. Now, if this does happen, and we do start to see unemployment rise, and we start to see wages come back under control, and where can the opportunities be in the housing market here? And I think the opportunities are going to be in, where they have been, where we discussed on this channel, are the people who need to sell, and especially if unemployment rises, the people who lose their homes or are forced to take a job beneath what they were qualified for when they purchased their home, and are now overextended on their mortgage payment, and it's becoming a burden on them, either because the payment's too high, or because they need to move to get another job, because there's not enough jobs in the area that they're in. In this case, here in Vermont. So I think that those types of buyers are a potential opportunity, and if you're out there searching for a home, or excuse me, those types of sellers are an opportunity to look for when you're out there home searching. If we do see these numbers, the unemployment number and the job vacancy number, so the unemployment start to rise, the job vacancies start to lower, like the Federal Reserve is shooting for. So look out for that in the future here. Again, the Federal Reserve is very clear that it's not something that we're seeing right now, and more, they want to hike rates more until we get to that level. As far as that the housing market, I think this is really, really bearish, and really not, for supply. It's really not, it's not a good sign. It's not something. It's not going to give builders a whole lot of confidence to go out there and bring a lot of new inventory into the market, like we need in so many of these markets, like here in Vermont. Especially on the affordable housing level. And in my opinion, I think that probably the safest investment. I mean, at least here in Vermont, I've talked about many times on this channel how, historically speaking, even through some of the worst recessions, Vermont hasn't seen a significant decline in median home prices. And in my opinion, the products that are a little bit cheaper, and maybe these starter homes, are I think even more insulated than homes that are more insulated to a price decline than homes that are a little bit more luxurious, a little bit bigger homes that maybe move up buyers would be interested in, things along those lines. So as far as downside risks, if there were higher unemployment and we saw demand continue to decrease from where it is now, I think those starter homes, smaller condos, that starter price range is a relatively is a relatively safe spot to be, as opposed to some of these larger luxury homes. But anyway, Liam O'Reilly, Vermont Economic Realtor. All of my contact information is listed in the description. If you're interested in purchasing or selling a home here in Vermont, I'd be happy to help you. Feel free to reach out by phone or email. Leave me a comment. Let me know what you think. Or if you want to reach out privately and let me know what you think as well, feel free to call, text, or email me. And I will see you guys in the next video.